If you watched my last video on Ultra FICO, we talked about how bank account data can enhance a traditional FICO score. But now we're going just a step further because Plaid, the company that connects your bank accounts to apps like Venmo, Chime, and many other fintech lenders, has developed something called LendScore. And this is different, guys. This isn't enhancing FICO. This is underwriting built on cash flow. So let's break it down. I have a video from the Plaid YouTube channel that I want to play for you all right now.
Think about how you manage your money today. There's new options in the market, and not all of that is showing up in traditional data.
Plaid is changing that. We're helping lenders understand, based on what's in someone's bank account, whether they're likely to repay a loan.
Ability to repay gives you a 360 view on the borrower.
So what's Plaid LendScore?
LendScore looks at cash flow, income patterns, and account activity to give a full picture of a borrower.
The score predicts likelihood of default in 12 months, and it's designed to complement, not replace, a traditional credit score.
It's a new way to think about credit decisioning.
Okay, 3 words to describe Plaid LendScore.
Predictive.
Robust.
Unique.
So what's different about LendScore?
It blends together cash flow data with an entirely new data set called Network Insights.
Network insights are behavioral signals.
It looks at how many accounts consumers connect, what types of apps they use, and how often.
What kinds of patterns can Plaid see?
Connecting to a wealth management app showed 20% lower risk of loan delinquency. But if you're using 10 or more wealth apps, it can signal double the default risk compared to a borrower not using any.
So how does the score work?
It's simple. When a borrower shares their bank account, we analyze raw transaction data and build them into usable attributes, which generates the score.
The score ranges from 1 to 99, along with reason code that explain what's driving it.
How can the score help lenders?
We're helping lenders access real-time data directly from bank accounts with minimal friction and out-of-the-box analytics.
They can book more loans, lower their losses, increase their profitability, and serve more customers.
What results are lenders seeing?
Subprime and near-prime lenders can cut risk 10 to 20% without reducing originations.
A lender using this score will get over a 25% better performance in underwriting than if they were not using this score.
The score is now available in beta, and you can sign up for the waitlist.
So this is something that is definitely on the horizon, guys. Don't sleep on this. Do not sleep on this. This is something that I can definitely see coming into the financial space. I mean, as far as banking, credit unions, I can see this being implemented in a lot of lending. And let's talk about it a little bit further. So just like I told you about the Ultra FICO, LendScore is not replacing FICO. Traditional lenders, especially mortgages and large banks, would still rely heavily on FICO. But fintech leaders and embedded finance platforms are increasingly using cash flow underwriting to approve thin file borrowers, evaluate gig workers, assess self-employed applicants, make faster decisions. FICO looks at debt history. LendScore looks at money movement and money management. Those are not the same thing. So this is definitely going to be something different in the consumer space, because as I told you before, using cash flow for capital in business, that's not something new. That's not new. Okay. So who does this help? This model may help people with limited credit history, young adults, immigrants with no U.S. credit file, gig workers, people who avoid credit but manage their money well. If someone doesn't have much debt history but maintains steady deposits and steady balances, this may work in their favor. And that can be powerful, okay? Because especially if you're someone that always pay cash, like my husband, he was one that always paid cash, kept cash in his account, never really relied on credit that much. But when it's time to get the big ticket items like the mortgage, stuff like that, you need a credit profile. So it's not going to replace that. So the important questions are, now, this is where we can think a little more critically, because this isn't just about opportunity. It's also about data access. When you connect through Plaid, you're granting access to your financial account data. That raises questions like, how long is data stored? How is it scored? Could spending patterns affect approval? What happens if your income fluctuates seasonally? This is the evolution of underwriting, but evolution always comes with some trade-offs. So the bigger picture, this is the future of credit. Okay, we're moving into an era of open banking, AI-driven underwriting, cash flow analysis, real-time approval models. Traditional credit scoring was built in a time when debt history was the primary data source. Now lenders have access to real-time transaction data, deposit verification, and your behavior patterns. This is not about replacing the FICO tomorrow. It's about expanding how risk is measured, and that changes the system completely. So this is something I'm telling you guys, this right here is going to change how lending is done in the future. I can see this being a real big thing in 2027 and beyond, because like the video said, it's in beta, it's a wait list. I can see, some people moving into it, especially in the actual banking space, because from my understanding, they're already using something like this for buy now, pay later spaces. Some loans are looking at your income information and income data by using systems like Plaid. So this right here is something that you want to be in front of, okay? Because when we talk about FICO TNT, which the T stands for trended data, that means that it can go back 2 years in your behavior patterns in your credit report. And I think that that's where a lot of our lending tools that's going to be used for risk assessments is going to go forward. They're going to be looking at how you have behaved, not just now, but in the past. They want to see how have you behaved in the last 2 years. They want to see a little bit more about the overall picture. And as I was telling you guys before, and especially if you're not new to my channel, the credit unions have always done that. They have always looked at more than just a score. They look at your relationship. They look at your overall financial picture when it comes to doing business with them. And so this is not going to be completely revolutionary, but this LendScore is going to be something that you will see more often. And I really do predict that by sometime 2027 going into 2028, I really do see this being very popular. Okay. And when it does, y'all make sure you come back to the channel and say, Starr, you told me so. Okay. So here's my perspective on this. So this is neither good or bad. It's powerful. If you manage your checking account responsibly, this could help you. If your cash flow is unstable, it may not. What matters is understanding that your financial footprint is expanding beyond your credit report. And as consumers, we need awareness before we click connect. Okay. So Plaid's LendScore represents a shift from did you pay your debt to how do you manage your money? And that's a big, big difference. We're entering a credit era where your behavior, not just your borrowing, matters. Okay. I want to hear from you guys. I don't want this video to go too long. I want to hear from you guys. Let me know, would you feel comfortable allowing a lender to review your bank account activity for approval? Or does this cross a line for you? Or are they doing too much? Drop your thoughts below. I really want to hear from you. And if you have not checked out the Ultra FICO video that I did right before this one, then make sure you check it out right now.